Imagine two people. Both are buying the exact same thing. Same product, same store, same day. But one of them pays almost twice as much as the other. No, this isn't a trick. There's no coupon the other person had, no special deal, no membership card. The only difference, one of them has money and one of them doesn't. Here's the uncomfortable truth that most people never talk about. Being poor is expensive. Genuinely, mathematically, financially expensive. And if you've ever struggled with money, felt like you were always one step behind, always trying to catch up, this video is going to explain exactly why. Because it's not just about how much you earn. There's a hidden system quietly charging you more for the simple fact that you don't have much to begin with. Let's break it down. People believe that if you're broke, your biggest problem is that you don't earn enough. And sure, income matters, but there's a second problem that almost nobody talks about, one that quietly drains money from people who can least afford to lose it. We assume that money is neutral, that a dollar is a dollar no matter who's holding it, that everyone has equal access to the same prices, the same options, the same financial tools. But that's not how the world actually works. The financial system was designed, sometimes intentionally, sometimes just by default, to reward people who already have money and charge extra to people who don't. It's a kind of invisible tax on being broke, and most people are paying it without even realizing it. So let's follow the money. Let's look at exactly where this happens and why. Where the hidden costs actually live. Let's start simple. Buying in bulk. When you have money, you can buy the large pack of anything: rice, toilet paper, soap, cooking oil. The large pack almost always works out cheaper per unit. You're paying less for the same thing just because you could afford the bigger upfront cost. But when you're broke, you buy the small pack. The small pack costs more per use, every single time. It's not a huge amount on its own, but multiply it across every household item, every week, every month, and it adds up to a quiet, constant drain. Now let's talk about banking. Most traditional banks require a minimum balance to avoid fees. If your account drops below that amount, they charge you. Sometimes $5, sometimes $15, sometimes more. So the people who have the least money are the ones being charged just for having a bank account. And if you don't qualify for a regular bank account, you might end up using a check cashing service or a prepaid debit card. These often come with fees for every single transaction. Depositing money, fee. Withdrawing money, fee. Just existing as a customer, fee. Now let's talk about rent versus buying. Here's a number that should make you pause. The average mortgage payment in many cities is actually lower than the average rent payment for the same type of property. So the person who owns their home is paying less each month and building wealth at the same time because the property is growing in value. The person renting is paying more and has nothing to show for it at the end of the year. Why can't the renter just buy? Because they don't have the down payment, and they might not have the credit score. So they keep renting, keep paying more, and the gap between them and the homeowner quietly grows. Then there's credit. When you have a good credit score, you get offered low interest rates. When you borrow money, you pay back only a little extra. When you have a poor credit score or no credit history at all, you either get rejected or you get offered a high interest rate, sometimes an extremely high one. So you're borrowing the same amount of money but paying back far more. The person with money pays less to borrow. The person without money pays more. And the irony?
The person who needs to borrow is usually the one who can least afford the extra interest. And finally, insurance. Studies have shown that people in lower-income zip codes often pay more for car insurance than people in wealthier neighborhoods, even with identical driving records. Same clean record, same car, same coverage, higher bill, because of where they live. Add it all together: higher prices per unit, bank fees, higher rent, higher interest rates, higher insurance. The person with less money is paying more for almost everything. This is what economists call the poverty premium, and it is very, very real.
Here's where it gets really interesting, because this isn't just a money problem, it's a psychology problem too. When you're struggling financially, your brain is under constant low-level stress. Researchers have actually studied this. They found that financial worry takes up mental bandwidth. It's like running too many apps on your phone at once. Everything slows down. This is sometimes called cognitive load, and when your mental resources are consumed by stress and scarcity, it becomes harder to think long-term. It becomes harder to plan, easier to make short-term decisions that feel necessary right now, even if they cost more later. Think about payday loans. The interest rates on these are extraordinary, sometimes 300%, 400%, even higher annually. Almost everyone knows they're expensive, but for someone who needs to pay rent today or risk getting evicted, the future interest rate is not the most pressing problem right now. This is called present bias. We value what helps us right now more than what hurts us later, and financial stress makes present bias even stronger. So the system is set up in a way that punishes people for short-term thinking, while also being designed to push people towards short-term thinking. And then there's something called the scarcity mindset. When you don't have enough of something, your mind becomes hyper-focused on that thing. If you've ever been really hungry, you know this. All you can think about is food. The same thing happens with money. When money is tight, your mind keeps pulling back to it. The problem? This focus on immediate money worries can make it harder to see the bigger picture, the long-term strategy, the slow, boring decisions that build wealth over time. It's not a character flaw. It's a predictable psychological response to a very real situation.
So, what do you do with all of this? First, awareness. Just knowing the poverty premium exists helps you fight it. When you're making a purchase and you see the smaller, cheaper option, ask yourself, is there a way to buy more at once and actually save money in the long run? Sometimes the answer is no, but sometimes you can find a way. Second, banking. If you're paying bank fees on a regular basis, it's time to find a better option. There are online banks and credit unions with no minimum balance requirements and no monthly fees. This is one of those small switches that doesn't feel dramatic, but over the course of a year, it adds real money back into your pocket. Third, credit. Building credit takes time, but it's worth starting now. Even a secured credit card, used responsibly and paid off every month, starts building your credit history. Over time, this reduces the interest rate you'll be offered on loans, on credit cards, on everything. The better your credit, the less you pay to borrow. Fourth, buy in bulk where you can, even if it's just 1 or 2 household items at a time. Buying a larger pack of something you use regularly almost always costs less per use. Over months, those small savings compound. Fifth, and maybe most importantly, protect your mental bandwidth. If financial stress is affecting how you think and make decisions, strategies that reduce that stress aren't luxuries, they're practical tools. An emergency fund, even a small one, acts as a buffer against the most expensive short-term decisions. Even a few weeks of expenses saved changes how you respond to financial pressure. You don't need to be rich to start fighting the poverty premium. You just need to know it exists and start making small, intentional moves against it.
Here's the uncomfortable thing about all of this. The system is not fair. That's not a political statement. It's just a financial fact. The structure of prices, banking, credit, and housing genuinely charges more to people who have less. But knowing that, really understanding it, changes how you see money decisions. It stops being about willpower or discipline or making better choices in some vague motivational poster kind of way. It becomes about understanding the system you're operating in, seeing the hidden costs, and finding the specific, practical moves that chip away at them, one at a time. Because here's what's also true. The same compounding effect that works against people when they're broke works for them when they start to get ahead. Once you have a small emergency fund, you stop paying the premium for being caught off guard. Once your credit improves, you start paying less to borrow. Once you can buy in bulk, your cost per use drops. Once you own instead of rent, your monthly payment builds wealth instead of draining it. The trap is real, but so is the exit. The people who get out of it aren't always the ones who worked hardest. They're often the ones who understood how the game was set up and started playing it differently. So the question is, now that you know this, what's the first small move you're going to make? If this video made you think differently about money, subscribe, because that's exactly what this channel is about. Not get rich quick, not hype, just the real psychology and mechanics behind why money works the way it does and what you can actually do about it.